Welcome back. We have been speaking with Sanjeev Sanyal, the economic advisor to the Finance Ministry, on consolidation among banks. But now we turn to the state of the economy. We turn to the big macro concern, the current account deficit. Sanjeev, I want to take you back to that Friday evening press conference. There were a bunch of steps announced to finance the trade deficit and the current account deficit, as well as to a promise was made that imports will be controlled and exports encouraged. Now, has the government finalized the list of import goods on which duties will be levied?
All options are being explored, and we will look at, including, if necessary, tariffs and other steps are being considered. But as I said, it will be done with a medium term in view. For the immediate concerns, the main thing remains that the Reserve Bank, which has more than adequate reserves, will continue to use its reserves to manage volatility. And I think a point that I made earlier and many times is that people get too excited about the bilateral exchange rate between the rupee and the dollar. The fact of the matter is the rupee, if you take a 5-year perspective of the exchange rates, has been broadly stable against virtually every exchange rate other than the dollar. So there was no particular reason for us to have heroically stood out while all our competitors and trading partners had depreciated. So an adjustment did happen. But let me also say that, as things stand, the rupee at current exchange rate and with government bonds at a little over 8%, I would argue that these Indian government securities are very, very attractive by global standards as a asset. So, do not think that this is a one-way street.
No, I agree with you, actually. Given the fact that the rupee is 13% down year to date and bond yields have jumped by, some 50, 70 basis points year to date, clearly attractive. And, each day we expect that financial portfolio investors will come back. But, let me stick with depreciation of the rupee itself. In itself, the fall of the rupee by about 10% this financial year, won't that correct the trade deficit? Have you done any calculation on how much the deficit may fall anyways, simply because of the depreciation of the last 4 to 8 weeks?
Obviously, we do have some internal estimates. But of course, these things take a medium term to work themselves out. These things do not have an immediate impact, particularly because the external environment itself is changing very rapidly because of, changing trade dynamics internationally. So trying to put numbers is very difficult, but we do have some broad idea. I think in the medium term, our exporters will be benefited significantly, and not to mention the fact that with this depreciated exchange rate, our securities are a lot more attractive than they were a little while ago.
Oh, yes, I take your point, both on shares and on bonds. But, just to come back to the calculation you all have in mind, how are you working towards this import control? How many $1 billion is the government targeting to save by imposing duties on imports?
No, I don't think that is how you do it, because the danger in that is that in order to hit some sort of a target like this, you will, force fit all kinds of barriers, tariff or non-tariff, and will end up eventually hurting the economy in some fashion. So you have to be very, very careful when doing these things, not the least because many of these items are inputs into things that are, our own industry and our competitiveness, number one. Number two, there are also WTO and other agreements, trade agreements on which we have signed up. So we have to be very careful that we do not sort of abrogate these international commitments. So given all of these things have to be done very, very carefully.
Oh, of course. I take that point that we cannot violate WTO guidelines. Well, what about export growth in that case? Should we expect some packages for some sectors?
Certainly, export promotion remains something we are keen on. But as I said, while packages can be put in place, they do take a little bit of time for response. So as far as the current exchange rate issue is concerned, that will continue to be driven both partly by international developments and partly by views on the stability of the Indian economy, which I think is in good nick. The Reserve Bank, when it feels like using some of its reserves to control volatility and these kinds of factors. The longer term export competitiveness of the economy, of course, will have a, it takes some time for these things to feed through. Obviously, expectations will feed through more quickly, but nevertheless, we understand that the real response of the economy takes some time.
Oh, so it does. Let me come to, exports in another angle. Some economists have been saying that our exports were receding even before demonetization and GST. The performance was even worse after these two events, demo and GST. This, at a time when the global economy and global trade was doing very well, all through 2017. Has the government done any study about what's hurting our exports?
So if you look at the very latest numbers, you'll see a very sharp increase in exports in the recent months. The issue is that we also are seeing very sharp increase in imports because the economy is accelerating, oil prices are high, and so on. So while there may have been some time ago, problem with export growth, that is not the issue. The problem is overall trade is actually booming if you look at the recent numbers in dollar terms, not just in rupee terms. So if I can't remember the exact number of the latest month, but it was something in the range of 17% exports and 19% imports, something like that. I forget the exact number, but they were very high.
Yeah.
Trade goes up and down.
Yep.
Indian exports are now, and remember, are now growing. And remember that these exports are happening on orders given at a completely different exchange rate. So the impact of the current decline in exchange rate, should there be one, will happen in the subsequent quarters. So it takes some time for these things to feed through to the real economy. But it isn't the case that the Indian exporter is now not participating in global expansion. The problem is that our own very strong growth and, very importantly, oil prices has meant that imports have also grown very, very quickly. And hence, the review that we said on this, even this discussion on essential, non-essential that is happening, is being driven by this observation. It's not being driven by so much the earlier debate of, trade, is trade slowing down? That's not the case. We now have, in fact, if anything, trade exploding out.
Okay. I take your point that crude is the big cause of trade deficit. Now, one way to restrain this import is allowing fuel prices to rise so that people automatically use fuel optimally. Is that the reason why excise duties on crude haven't been cut?
So there is two issues here. One of them is, the longer term, yes, if you keep oil prices somewhat more expensive than otherwise, then there is some effect of being more energy efficient. And yes, in the longer term, that is the case. Hopefully that also encourages us to move on to other forms of energy and so on. But nearer term, I think the feed-through that has been allowed is to do with simply being good bookkeeping. If you allow feed-through, and it's a reform that we had done some time ago, that, it feeds through to domestic prices and does not accumulate into big oil bonds and other deficits that in the past ended up accumulating and then becoming a problem for subsequent years when you had to pay off these large debts. So the judgment was made some time ago that this was a reform we needed to do and allow this feed through to happen. And so that is what is being done. Now, obviously, at some point, if it keeps going up, then judgments may be taken that you may have to do something about excise or some other taxes. But remember, every time you make a call of that kind, it means that you are not spending on something else. So there is no free lunch in all of this. So the right answer depends on what trade-off you make.
No, I take your point. Well, a final question to you, Sanjeev. You know, a standout announcement over the weekend actually came from the government on Saturday that it will absolutely stick to the fiscal deficit of 3.3%. The government, while committing to the 3.3% fiscal deficit, also said it is confident of achieving its revenue targets, its tax revenue targets. But how will it achieve that? If you look at the GST collections, they are running at 95,000 crores a month. Now, we actually need 1.1 lakh crore a month to reach the budgeted GST revenue figure of, I think, 13 lakh crores. So, is that figure achievable?
Because the Indian economy has always, as you know, has a cycle where the first half of the financial year generates, I don't know, 40% of the GDP, and the second half of the financial years, or a little more than second half, starting around about September onwards, is when you have what is called the busy season. So we have this seasonality. I don't know, there may be some old agricultural reason for it, but this is how our economy still continues to be. So therefore, given that this cyclicality exists, it will also show through into our revenue collections, or at least that is what is expected.
Okay, we'll leave it at that. Sanjeev Sanyal, pleasure speaking with you. Thank you very much indeed for joining us. So looks like for the moment there is no immediate commitment of another merger, but government waiting and watching to see how this one plays out. Thank you very much for watching this special show, State of the Economy.